You know that feeling, right? You're in business, the clock's absolutely ticking, management needs an answer. Like, now, should we grab this special contract? Should we shut down that division that's struggling?
Yeah, the pressure's intense. No time for a massive analysis.
Exactly.
And that's really where relevant costing is, well, it's a lifesaver, honestly. We've got this great visual overview from a performance management course.
Yeah, I saw that. It looks really helpful.
It really is. It systematically shows how to, sort the important stuff from the noise when you're under the gun.
Okay, so that's our mission for this deep dive then. We want to equip you, the listener, with these core ideas of relevant costing. And then apply them straight to, what, 4 common high-pressure business decisions? The short-term ones?
Exactly. And it's not about, like, full-blown accounting theory. It's about finding the numbers that actually change depending on what you decide.
Yeah.
The ones that matter right now.
All right, so let's build that foundation. Before we tackle those tricky decisions, we need to nail down the main concept: relevant costs.
What exactly are we looking for? And, just as importantly, what do we ignore straight away?
Okay, so relevant costs are basically 2 things. They have to be future cash flows, so things happening after the decision.
Okay, future.
And they have to be incremental, meaning they only happen because of the decision.
Ah, okay.
If a cost is already spent or if it's going to happen anyway, decision or no decision, toss it out. It's irrelevant.
So the framework helps you get, like, tunnel vision. Focus only on what changes.
Precisely. Focus on the financial consequences of this specific choice, nothing else.
You said incremental. Can we just pause on that for a sec? Because sometimes people think incremental just means variable costs.
That's a really good point, yeah. An incremental cost is any extra cost you incur directly because of the decision.
Okay.
Now, most variable costs, like buying more raw materials, are incremental. Usually.
But not always.
Not always. Like, say you've got a warehouse full of materials you bought ages ago, and honestly, you have no other use for them.
Right. Gathering dust. Exactly. The money you spent back then, that's history. Irrelevant. But if you need to buy new stuff for this specific special order,
then that cost is incremental and relevant.
you got it. That new purchase price matters.
Okay, that helps clarify what to look for. What about the stuff we kick out immediately? What are the big irrelevant costs?
Well, the biggest one is past costs, what we call sunk costs.
Like the old materials we just mentioned.
Exactly. Money already spent and gone. The other big category is future costs that just won't change no matter what you decide.
Like rent on the main office building.
Perfect example. If your head office rent is fixed for the year, taking on one special order isn't going to change that payment.
Nope, still got to pay it.
So it's irrelevant to that specific decision. We're laser focused on changes in actual cash moving in or out because of the choice we make, not history, not stuff that's set in stone.
Got it. Now, the source material we looked at really highlighted one concept, almost put it on a pedestal above the others: opportunity cost. And I think this is where businesses often slip up. They see the money going out, the expenses, but they don't always see the money they're giving up by choosing one path over another.
That's spot on. Opportunity cost is so central because it forces you to think strategically. It's all about scarcity, isn't it?
Scarcity? How so?
Well, you rarely have unlimited resources, limited machine time, limited skilled workers, limited cash.
Sure.
So every time you use a scarce resource for one thing, you're automatically not using it for something else. That something else might have been profitable, that's the opportunity you're potentially losing.
Okay, so if we need a definition, what is opportunity cost formally?
It's defined as the maximum net revenue or contribution, basically the profit you could have earned from the best alternative use of that resource.
Can we make that more concrete, like an example?
Sure. Let's say you have one super specialized machine. It can make product A, which nets you, say, $10,000 profit.
Right.
Or it could make product B, which nets you $15,000 profit. Same machine time.
Right.
If you decide to use the machine for product A, your opportunity cost is that $15,000 profit you sacrificed by not making product B.
Ah, okay. It's the value of the foregone alternative.
Exactly.
The best foregone alternative.
So its role in decision-making isn't just some accounting number. It's more like a strategic filter.
Totally. It basically asks, is this the absolute best use of this limited resource? Don't tie up your best machine or your best people on Project X if they could generate way more value doing Project Y.
So when does it really become critical to factor this in?
The moment a resource becomes a bottleneck, constrained machine time. Maybe you only have so many hours of expert labor, even limited factory floor space.
Right.
As soon as there's competition for that resource, you must calculate the opportunity cost. The path you choose has to offer a better return than the best alternative you're giving up.
That's the difference between just making a profitable decision.
And making the optimal one? Yes. Okay, that explanation of opportunity cost really sets the stage. Knowing we have to weigh these incremental costs and consider what we're giving up, now we can look at applying this. The visual roadmap laid out 4 key areas where these principles get used all the time. Hashtag tag, 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 GKSTTO2. Applying principles to specific short-term decisions. Let's kick off with one that probably feels really immediate for a lot of people.
Yeah.
The one-off contract, the special order.
Right. A customer calls, wants a massive order, maybe it's a bit unusual, and they want a discount. Lower than your normal price.
Yeah. Tempting, but risky. So what costs become relevant here?
Okay, first you look at the selling price they're offering. That's your potential inflow.
Right.
Then you compare that against the total incremental cost just to fulfill that specific order.
Which includes?
Well, definitely any extra materials you have to buy specifically for this job.
Okay.
Any extra labor, especially if it means, say, paying overtime rates you wouldn't normally pay.
Makes sense.
And any variable overheads that directly increase because you're making this extra batch. Things like power for the machines running longer, maybe some factory supplies.
Got it. What about using our existing machines? The source mentioned non-current assets. If this order needs special equipment, we already own.
Good question. It depends. If that machine is just sitting idle doing nothing, then the relevant costs might just be the extra running costs, like electricity, maybe a tiny bit of wear and tear, often pretty low.
Right.
But if that machine is normally busy making your standard high-profit product for your regular customers,
then using it for the special order means not making the regular stuff.
exactly. And that's where opportunity cost just slams the door. You have to include the lost profit, the lost contribution from the regular work you're displacing. That lost profit is a very real, very relevant cost of taking the special order.
Okay, so the numbers might say, yes, the price covers the extra materials and labor,
Right.
but the opportunity cost might make it a definite no.
Absolutely. And let's add another layer here, maybe more strategic. Even if the numbers, including opportunity cost, look okay. What if taking this big, low-margin order means you delay delivery to your loyal, high-paying customers?
Ooh, yeah, that could damage relationships.
Right? That's one of those other factors that aren't strictly cash flow right now, but it's definitely an incremental risk or potential future cost. Good management has to weigh that too. Is the short-term gain worth potentially upsetting your core business?
That's a crucial non-financial point. Okay, moving from taking on new work to maybe getting rid of some. Let's talk about the really tough one. Deciding whether to close a branch or maybe a whole product line, shut down decisions.
Yeah, never easy. And the relevant costing here is about balancing the costs you save against the cash flows you lose.
So what cost do you actually save? What's relevant on the savings side?
It's the fixed costs that will genuinely, truly disappear if you close that unit.
Like,
Maybe rent specifically for that branch's building, salaries of supervisors who only work there and wouldn't be moved elsewhere, insurance policies just for that operation, costs that vanish completely.
okay, but hang on. When I look at the P&L for that failing division, it probably shows a big chunk of allocated head office costs, right? Like IT support, central marketing.
Always does.
If the goal is to cut costs, surely getting rid of those millions in allocated overheads is relevant.
That's the classic trap. It feels intuitive, but no. Those allocated head office costs are usually irrelevant to the shutdown decision itself.
Why? They make the division look unprofitable.
They do make the division look bad. But think about the company as a whole. Does shutting down the division make the head office disappear?
No.
Does the total rent bill for HQ go down? Do the central IT servers get switched off?
Probably not. Those costs just get reallocated to the remaining divisions, right?
Exactly. So for the overall company, there's no actual cash saving from that allocation disappearing. The total cost stays the same. You only count the fixed costs that are directly tied to the unit and will vanish entirely when it closes.
That distinction is huge. Focus on cash flow changes for the whole company, not just shuffling costs around internally.
You got it. Now, besides saved fixed costs, you obviously have to factor in the revenue you'll lose. That's a big negative cash flow impact.
Right.
And then there are the other financial factors. Sometimes the biggest hit isn't the lost revenue, it's the immediate costs of closing.
Like redundancy payments,
Right.
severance packages.
Precisely. or costs to break a lease early, costs to dispose of assets safely. These can be massive upfront cash outflows.
So even if you save fixed costs over the long run, the immediate closure costs could make it financially painful in the short term.
Absolutely. Sometimes those upfront costs are so high, it might actually be cheaper in the short run to keep the unit limping along at a small loss rather than trigger those huge closure payments.
Okay, let's shift gears to something a bit more positive. Adding value. The decision whether to sell something as it is now,
At the split-off point, yeah.
right, the split-off point,
Yeah.
or spend more time and money to process it further, hoping to sell it for a higher price.
Yeah, this is super common in industries like, say, oil refining, food processing, chemicals, anywhere. One raw material naturally yields several different products partway through.
Okay.
The split-off point is just that stage where you can first identify and potentially sell those separate products. And crucially, for this decision, all the costs you spent getting to that split-off point.
Let me guess. Sunk costs.
Yeah.
Irrelevant.
Bingo.
Yeah.
Doesn't matter how much it costs to drill the oil or grow the crop up to that point, that money's gone.
So it's purely about what happens next.
Yeah.
A forward-looking comparison.
Exactly. Super simple comparison, actually. You look at the additional costs of doing that, further processing extra materials, more labor time, maybe running specific finishing machines,
Yeah.
and you compare that directly against the incremental revenues. That's the difference between the final higher selling price and the price you could get right now at split-off.
And the rule is?
Process further only if that extra revenue is greater than the extra costs. If not, sell it as is at split-off. Don't throw good money after bad.
Seems straightforward enough. Are there hidden traps here? Other factors?
Capacity is often the big one again. Opportunity cost, basically.
Ah, right.
If that further processing ties up a machine or skilled workers that are already really busy.
Then you have to factor in the profit you're losing from the other work that machine could have been doing.
Exactly. So even if the further processing looks profitable in isolation, extra revenue, extra costs, if it bumps a more profitable job off the schedule, then overall it's a bad decision. You need to consider the opportunity cost of that scarce capacity.
Right. Final one. The classic. Make or buy. Should we make this component ourselves in-house or just buy it from an outside supplier?
Ah, the eternal outsourcing question. This one involves balancing immediate costs with maybe longer-term strategic stuff.
So let's start with the case for making it ourselves. What are the advantages of making from a relevant cost perspective?
Primarily, it's avoiding the purchase price you'd pay to the external supplier. That's your main saving. So the comparison becomes, what's the supplier's price versus our internal incremental cost of making it?
Incremental cost here means?
Usually, it's the variable costs, the extra materials, the direct labor, the variable overheads specifically needed to produce that component.
Assuming we have the capacity to do it.
Crucial point. If we have spare capacity, machines are idle, workers have downtime, then often the only relevant internal costs are those variable costs. Fixed costs, like factory rent, usually don't change, so they're irrelevant in this specific comparison if capacity is free.
So if our variable cost is lower than the supplier's price, and we have the spare capacity, making it looks cheaper.
Financially, in the short term, yes. But,
There's always a but.
well, using that spare capacity isn't always free, is it? We're back to...
Opportunity cost.
Yeah.
If that capacity might be needed soon for something more profitable.
Precisely. If using the capacity now to make this component means we can't take on a lucrative customer order next month, that lost profit is an opportunity cost of making it internally.
Okay, what about the other side? The disadvantages of making it ourselves?
Well, beyond opportunity cost, maybe the external supplier is just better at it. They're specialists, so potential issues with quality control if we do it ourselves.
Right. We might not have the expertise.
Exactly. Also, reliability of supply. If we make it, are we sure we can consistently produce the volume needed on time? And then there's the risk of fixed costs increasing later. If we start making it now using spare capacity, but demand grows, we might eventually need to buy new machines just for this component. That increases our fixed overheads down the line.
So the initial comparison of variable cost versus purchase price might be too simplistic?
Often, yes. Which brings us to those other relevant decisions the source mentions. These are often the strategic tiebreakers.
Like what?
Things like, do we want to rely on an external supplier for such a critical component? What if they raise prices later? What if they have their own supply chain issues?
So control and risk mitigation.
Exactly. Maintaining control over quality, ensuring reliable supply, maybe protecting proprietary technology if the component is sensitive.
Yeah.
Sometimes a company might choose to make it, even if it looks slightly more expensive on paper based purely on variable costs, just for that strategic control. Or conversely,
They might choose to buy it, even if it costs a bit more.
yeah, maybe to guarantee quality from an expert vendor, or to avoid the headache of managing that production process internally. Or maybe to maintain flexibility, it's easier to switch suppliers than to shut down your own production line. The decision is rarely just about pennies saved today. Hashtag tag tag outro.
Okay, wow. That was a really efficient deep dive, cutting through a lot of the complexity around these short-term decisions.
Mm-hmm.
We've basically established that the whole framework really hangs on getting the relevant costs right, future incremental cash flows,
Yeah.
and always keeping that opportunity cost in mind, especially when resources are tight.
Absolutely. And we saw how those rules play out in those four key situations. The one-off contract, weighing marginal gain against capacity cost.
Right, the shutdown decision, being really careful to only count saved fixed costs, not just allocated ones.
Yeah. That further processing, that simple compare the extra revenue to the extra cost calculation, remembering capacity constraints.
And finally, make or buy, balancing those internal variable costs against the purchase price, but also factoring in strategy, quality, and risk.
It really boils down to disciplined focus, which cash flows actually change because of this specific decision.
So for you listening, trying to take this beyond just the business context, what's the big takeaway?
Well, you've just heard how accountants get really strict about defining relevant costs when it comes to money.
Right, yeah. Future incremental opportunity cost.
Okay, now take that exact same logic
Yeah.
and apply it to maybe the most constrained resource you have in your own life, your time, your energy.
No.
If you choose to spend, say, 2 hours tonight scrolling social media or maybe attending a meeting you know will achieve nothing, what's the opportunity cost?
What else could I have done with those 2 hours?
Exactly. What higher value activity? Learning something new, connecting with someone important, working on a passion project, even just resting. Did you sacrifice by using your limited time and energy capacity on the lower value thing?
Ah.
Relevant costing, at its heart, teaches you that true efficiency isn't just about tracking what you spend. It's about constantly asking, what am I giving up? Knowing the value of the next best alternative.
A shift in perspective, focusing on the opportunity cost of our time.
That, I think, is the ultimate takeaway. It applies everywhere.